All right, so in this video, I'm going to go over some of the problems in module one, the module one problem set that begin really with case five and move into case seven. And what these problems, there's really two approaches you could take to them. One's not going to get you much in the long run. One will actually enrich your understanding and help you through the rest of the class. Um, it can be easy to see these problems as simple calculation problems. You're just plugging numbers into an equation, solving for the unknowns. And that'll get you the answer, but it doesn't pay off. It doesn't help you understand what's to come later. So what we're really trying to get a sense of is truly the integration of the financial statements. We want to talk about the balance sheet, the income statement, and the statement of retained earnings in this case. It's so imperative that you understand how those three items are linked together. And then the calculations are just an application of that idea. So I'm going to talk a little bit about the setup and why it is set up the way they are, and then we'll apply it to a couple of these problems. Right, so I'm going to switch over here to my doc cam for a bit and just write down some of the things we've talked about. So what underlies the framework of this problem, what really, if you will, defines the edge of the map, the edges, the beginning and the end, is the balance sheet equation. And we talked about the balance sheet equation being assets equals liability plus equity. And I'm going to break equity apart into a common stock account. And it's important to understand that this includes all direct investments, really. I'm just calling it common stock because that's the most common, if you will. And that's the direct investment that you've been exposed to the most. But this is really all direct investments. And then you have retained earnings, which is the indirect investment made by the company by whatever it's earned, but it hasn't paid out. So this is our indirect investment. So what are the other direct investments? One really that you need to be cognizant of in these problems is that additional paid-in capital, APIC, is a part of that direct investment. Remember, when we sell stock, we record some of that amount in APIC and some of that amount in common stock. And I'm going to zoom in a little bit there. So everything we own comes from two sources. Either it was invested by the company or people outside the company into our company, and obligations. This is true, but only at a point in time. So we might have, for example, assets at 1-1, liabilities at 1-1, common stock and APIC at 1-1, and retained earnings at 1-1. Now, all of these at the beginning of the year have to be equal. And it's true too, then, that at the end of the year, when all of these are totaled up at December 31st, they must still be equal to one another. So as I mentioned, the balance sheet is what frames out our discussion, our ability to really encapsulate the components of a business at these times. And I'm going to flip over to a real world balance sheet that I will revisit later in the year. And so this balance sheet, I have a few of them. The very top one is from Alphabet, and that's Google. That's the parent company of Google. So this is their balance sheet, and this is for the year 2015. So they give me two columns of information. They give me the end of the year 2014 and then the end of the year 2015. So this is the beginning of our map, this 2014 column. This is where we started at, this is where 2015 began because it's the end of the prior year. And then this is where they ended up in the year that they're reporting for. So balance sheets are at a moment of time. That's why these tell me as of December 31st, 2014, as of December 31st, 2015, right? They're only true at those dates. And then we have total assets at the end, the beginning, We have total liabilities and shareholders' equity at the end and the beginning. So they break them apart here, but not in the way that we have a total liabilities versus a total equity line to compare the two. Basically, we're drawing what I put up on this paper. This is what we saw. It's just laid horizontally rather than vertically. This is the end of the year they're reporting for. And they don't talk about January 1st on their balance sheet, but they do the end of the prior year. So these are the balance sheet, basically. This is balance sheet information we're pulling from. What happens during this year now is a sort of a mystery, right? This is where we will debit and credit accounts, assets and liabilities will move, maybe equity will move. Retained earnings doesn't move during the year because we have to capture all of the net income that happens during the year. And so this is the company's earnings for that period. This is the earnings they made between 1/1 and 12/31. Then we subtract the dividends they paid between 1/1 and 12/31, and that gives us ending retained earnings. So that's a statement of retained earnings, pure and simple. If we're just doing a statement of retained earnings, it's our beginning retained earnings plus net income less dividends. And that would be now the accumulated earnings the company has in the company, that it's kept in the company, I should say. All right. What can happen here is also very limited. I've referred to this as a closed system, meaning that no effects to retained earnings that you have to worry about now, except for net income and dividends. Those are the only two things that change retained earnings over an accounting period. Assets, lots of transactions affect assets. Spending cash, receiving cash, making credit sales, buying buildings, equipment, selling those items, right? Tons of things can happen with assets. Liabilities, the same story. These aren't closed off to just a couple particular accounts like retained earnings is. But there is movements going on, right? I can't track all of them. Here, this is a pretty closed account too, in terms of the only thing that really affects it positively is stock issues, stock sales, sales of the company's stock. Remember, the word issue is just another word for sold when we're talking about selling bonds and common stock on public markets. So these are the only three things that can really happen to our equity account as far as we're concerned in this point in the course. Lots of stuff can happen over here. This is the complete framework. Well, how do the financial statements fit in? As I mentioned, this is the balance sheet. This is the statement of retained earnings. And then, of course, net income is revenues minus expenses plus gains minus losses. So that's how we determine net income. And that's where the income statement fits in. So we determine net income, then we can figure out retained earnings. Then we can create a balance sheet that has totals, the new totals at the end of the period.